Up to this point, we've been talking about individual stocks. Some of you may not want to buy individual stocks. Instead, you may want to invest in diversified investments and let the professional money managers handle the money for you. Warren Buffett once said that if you do not have the time, interest, or expertise to research individual stocks, then your best bet is to invest your money into a passive fund such as the S&P 500 index, which is a passive investment strategy. If you want to participate in the stock market but may not be ready or may not be interested in participating via buying individual stocks, then there are a few solutions for you. You can invest in diversified investments. And today we're going to compare the two most common types of diversified funds. They are mutual funds and exchange traded funds, which are also known as ETFs. They definitely have some similarities, but they also have huge differences, which many investors may not be aware of. We will explore those differences in this section, and we will go over the pros and cons of each, and then we'll wrap up the section by doing a side-by-side comparison of the two. Once again, I am not your financial advisor. I'm not here to give you specific investment advice or recommendations. I am here to teach you, so anything I talk about today should be taken as educational and illustrative purposes only. So today we're going to talk about mutual funds, and then something that you really need to be aware of. Those are internal fund fees. And then we're going to talk about exchange traded funds, which a lot of people refer to these simply as ETFs. Mutual funds and exchange traded funds are great ideas for someone who wants to start putting your money to work in the stock market, but maybe you don't have a sizable portfolio to have enough diversification through buying individual securities. Investing in a single mutual fund or an ETF can give you diversification into as little as 20 stocks and as much as a few thousand stocks with a single purchase of one mutual fund or even just one share of an ETF. Let's first start off with mutual funds. Mutual funds were designed so that an average investor will be able to have the same opportunity for diversification as the large institutional investors without having the requirement of a massive investment portfolio. The number of holdings that are in a single mutual fund can be anywhere from 20 companies on the low end to 200 companies. And index funds, such as the S&P 500 or the Russell 2000, have even more companies within that one fund. Investing in the 200 plus companies that are in many mutual funds would require a large investment portfolio if you're to make those purchases outside of a mutual fund. So you're going to buy each one of those 200 stocks individually. That would be very time consuming, and the commissions to purchase 200 plus stocks would also add up to a small fortune. However, you can invest in most mutual funds with an initial investment as little as $1,000. And there are some fund companies out there that have smaller initial deposit requirements too. I believe American Funds has a $500 initial requirement. Here are some mutual fund characteristics. Mutual funds are designed with specific objectives which help you to narrow your choices. For example, now that you know what a large cap stock is and how that differs from mid caps and small caps, and you also know what growth stocks are, you may search for a mutual fund with the main objective of large cap growth or large cap value. The fund company and managers select investments that meet certain criteria. For example, if you select a large cap growth fund, the manager of that fund can only invest in stocks that are large caps and growth oriented. I'm going to come back to this in a minute because this could come back to hurt you. Diversification with just a single purchase make mutual fund investing very desirable, especially for those who don't want to manage their own portfolio. The fund managers decide when to buy and sell investments. Not always, sometimes the investors have control over that decision. And I'll explain to that in a moment as well. Most mutual fund portfolios, as I said, consist of 20 to over 200 different investments with one single purchase. When you buy shares in a mutual fund, your money is pooled with assets of other investors. This can have devastating consequences. Remember earlier when I said that emotions will kill your portfolio returns? I'm going to explain this in a moment as well. You can choose to have any profits or distributions paid to you by check, deposited into an account, or reinvested back into the fund. And any taxable earnings will be reported to the IRS, even if you reinvest them. So I want to share a story with you real quick so you can understand how having your money pooled together with other investors can hurt you, as well as how fund managers make investment decisions within certain criteria. So I'm going to go way back in time, back in 1999. So some of you younger students might not even be around by then, but I'm 45, so anyone my age or older will remember this. So in 1999, any stock that had a .com after it was just flying through the roof. The market was just on a tear. And let's assume for a moment that I am a fund manager. I run a mutual fund, and the criteria of the fund that I manage is large cap growth. That means that anyone who gives me money to invest, me being the fund manager, I can only invest in large cap growth stocks. I can't invest in large cap value stocks because that's not the criteria of my fund. I can't invest in small caps or mid caps. I can't invest in money markets or any type of bonds. I am a large cap growth manager, so I can only invest in large cap growth stocks. So back in 1999, large cap growth was doing phenomenally well. Actually, it was doing too well because the market was insanely overvalued. So me being a professional money manager, someone who should know valuations and should know when to buy and when to sell, at that point back in 1999, heading into early 2000, everything was just insanely overvalued. And now that you guys know what PE ratios are, there were some companies that were trading at a price earnings ratio of over 1,000. I've never seen that in my life. So here's how this can hurt you. People were giving me money. Me, again, I'm using an example that I am a large cap growth manager. So people were throwing money at these fund managers because they see their friends, their coworkers, their neighbors making these huge triple digit rates of return back in early 1999 and then going all the way through towards the end. And everyone wanted to hop on that bandwagon. So they're throwing money at these fund managers. So me being an educated fund manager, I should probably be selling right now. I should be selling and taking profits because we sell when things are overvalued. We don't buy when it's overvalued because that's how you get crushed. But me being the portfolio manager that runs a large cap growth fund, when investors are giving me money, I have to invest that money. And I have to invest that money in only large cap growth stocks. I can't take that money investors are giving me and invest that into a money market account because I'm not a money market fund manager. I'm a large cap growth fund manager. I can't take those stocks and put it into sectors that are undervalued. Maybe small caps were undervalued at that point. I can't remember, but even if they were, I couldn't take that money and invest in small cap stocks. I had to invest in large cap growth at overinflated prices. So here's how having a strict fund criteria can hurt you because I can only invest in that. And here's how having your assets pooled together with other investors can hurt you as well. So people are throwing money at these fund managers at the wrong time. Things are overvalued. 2000 comes and the dot-com bubble bursts. So the market starts coming down. 2001, we had 9/11. The market got crushed again. So people were still hanging in there. Some were starting to get out at that point. And then you had the collapse of Enron and WorldCom. You had the accounting scandal. Some of the major accounting companies in the United States were creating fraudulent accounting statements. There was fraud in the market. So people said, the heck with this, I'm getting out. They didn't trust the market. The market was getting beat up. Plus, you had fraud. There's a lot of uncertainty because of 9/11 and terrorism. So it was one of the worst times in the market, and people started getting out. So again, here's how the emotions of other investors can hurt you. When the market gets beat up, we now know as value investors who know how to value stocks, know how to find great companies and buy them when they're at a discount. Well, 2000 started creating discounts. 2001, after you had 9/11, there were even bigger discounts. And by 2002, when you had Enron and WorldCom and the accounting fraud, the market was just completely beat up. Me being a smart fund manager knows that I should be buying everything. Everything is at dirt cheap prices. It's an opportunity of a lifetime to buy these great companies at very favorable prices. But I can't do that. And here's why I can't do that. Average investors invest on emotions. So now they're starting to get out. Instead of putting money in now that the market is at very low prices, they're getting out. So they got in at the end of 1999 when things were so overvalued. And now in 2001 and 2002, they're throwing in the towel and they're getting out. So I don't have any money to buy these great companies at great prices. I have to take these redemptions from these average investors that don't know what the heck they're doing. I have to take the redemptions and I have to sell the stocks that they own inside these mutual funds and give them their money back. So because they're making redemptions, I have to sell at these low prices. I don't have new money coming in where I could take that and invest in this low price. So we bought back at the peak in 1999. The market got the crap kicked out of it, and now people are asking for their money back. and I have to do that. So I can't take advantage of low prices. I am now selling at bottom floor prices. That is how investing in mutual funds can hurt you. Your money's pulled together with assets of other investors, and mutual fund managers have their hands tied as to what they can invest in. That's an extreme example because that's something that happened back in 1999 when we saw extremely exuberant prices, and then things just got the crap kicked out of it, all in just a matter of a couple of years. But that is an example of what could happen when your money's pulled together with other investors. Unlike stocks and exchange traded funds, mutual funds trade only once per day, and that's after the market closes at 4 p.m. Eastern Standard Time. If you enter a trade to buy or sell shares of a mutual fund, your trade will be executed at the next available net asset value, which is calculated after the market closes. The fund company takes care of administrative tasks and provide you with regular updates on performance, and that service costs money, and it's in the form of an internal fee that we really don't see because it's deducted from the fund's total rate of return. It's not a check that you have to send to the mutual fund company. That's just part of the total fees associated with mutual funds. Did you know, according to John Bogle, and this guy knows a thing or two about mutual funds and investing in the stock market because he's the founder of Vanguard, the average annual mutual fund fee, according to Bogle, is 2.27%. And this does not include financial advisor fees or any commissions to buy and or sell your funds. Is that a high fee? Well, decide for yourself. Let's take a look at this chart right here. Here's how much that fee will cost you. In this example, we have an investment account valued at $100,000. We're going to calculate the long-term effect that an annual fee of 2.27% will have on your retirement nest egg. We are not including a sales charge. Some funds charge commissions to buy them. We're not including that. We're not going to include redemption fees. And if a fund doesn't charge an upfront commission, they may charge a back-end early redemption fee or just a 1% annual ongoing fee. We are excluding that from this calculation. Also, if you have a financial advisor that charges you 1% or 1.5%, 2% of assets under management, we're not including that either. Obviously, if we did, it would make this look that much worse. So let me show you how this is going to cost you over the long run. Just including the annual internal operating expense on a $100,000 account, earning 6% annually for 25 years, the portfolio would have grown to $429,000. That's not too bad. But since we're paying 2.27% each year, that adds up to over $187,000 in total costs. About $95,000 are actual fees that you have to pay, and the other $92,000 are opportunity costs where the $95,000 in fees could have been reinvested somewhere else, earning 6%. The total fund value with fees included, it's not $429,000, it grows to just $241,737. The fees reduced your portfolio over the long term by 43.68%. Do you think you would be better off without a 43% reduction in future value of your retirement account and an extra $187,000 in your retirement account? And here's what it will look like if you earn the average long-term rate of return of the S&P 500. So every other input here is the same, but our rate of return is 9.38% instead of 6%. So what you see here is the portfolio could have grown to $940,000, but instead you have $410,000 in fees and opportunity costs. So the portfolio is now just $529,000. That is the impact of just 2.27% over a 25-year time period. Again, we're not including asset under management or commission fees. What are these fees and where can we find them? First is the expense ratio. Every time the fund manager buys and sells stocks, and that occurs on a daily basis, there's small fees associated with that. There are commissions to buy and sell stocks, and that comes out of our pockets, us being the investors. Also, the fund manager gets paid to run the fund, so there is a manager's fee. And then finally, there is a 12B1 fee, which is the admin fee. So these are all considered internal fees, which is separate from transaction fees, such as your commissions, whether you're buying an A share, a B share, or a C share fund, and I'll explain that in a minute. This internal fee comes out of the fund's net performance and the value of your investment. This can be found very deep somewhere in the very small font in the fund's prospectus, or you can find it real easy on Morningstar.com using the free version of Morningstar. They extract all the data from every fund's prospectus and they put it on there for you, so it's very simple to find. The fund we're looking at right here does have a deferred fee of 1%. This is called a C-share fund. There's no upfront cost to buy it or a back-end early redemption fee, but you do have an annual sales commission of 1%. This is completely separate from the other fees / expenses that we see right here at Morningstar. Those are also known as your internal fees. Here you can see that the net expense ratio, the management fee, they get paid to run the fund, the 12B1 fee, the administrative fee, etc. And just looking at the deferred annual commission and the net expense ratio, you're paying more than 3% every year to own this fund. And you wonder why your account is underperforming. I'm not making this up. This is disclosed in the prospectus, and Morningstar gets their data from there. So what we see right here, this is the 1% deferred fee. So you're paying that every single year. Then you have this 2.11% net expense ratio. This comes out every single year. This comes out, and this comes out of your fund's net performance. This is a screenshot of what it looks like on Morningstar, but I'm actually going to show you where to find this information. Let me share my screen with you one more time. And I'm going to start from the beginning. Morningstar. And then we're going to come up here to the top left, type in the ticker symbol or the name of the fund. I'm going to type in the name of the Thornburg value. Click on this right here, and that's going to bring you to a summary page. That screenshot said click on other fees or expenses. Morningstar recently changed the layout of some of the things here, and this is one of them. So they changed other fees / expenses to now it says price, which doesn't make sense. I would think if I click on price, I'd see what the price per share is. But actually, if you click on price, that will take you to other fees / expenses. And they are a wonderful 1-star rated fund, probably because their fees suck so bad. Here are the sales charges. There's no front-end fee, there's no back-end fee, but since the C share, it has an ongoing 1% annual fee right here. So 1%, then we come down a little further, and here are the internal fees. So you see that back in 2019, it's actually in 2019, they reported 2018 figures, which I showed you on that screenshot. Their internal fee was 2.11%, and now they raised that fee to 2.19%. How nice of them. And then here are the other fees. You have the manager's fee, you have the 12B1 fee, the administrative fee, and whatever other fee you could think of. Whatever other fees there are, this fund is adding them to it because you have a 2.19% internal fee plus that 1% deferred load. That's a lot of money. We showed you what the impact would be on just a 2.27% internal fee. Now imagine adding over 3%, how bad that's going to hurt your portfolio over the long term. So let me get back to the presentation. In addition to the internal fees, there's no such thing as a free fund. I'm talking to you, you no-load fund disciples. There's also a fee based on how your funds are purchased. If you buy an A-share class, an A-share fund charges a commission upfront, usually between 4 to 5% of the initial investment for stock funds and about 3% for bond funds. Your portfolio is down right out of the gate due to this fee coming out of your initial investment. However, the internal fees on A shares are lower than B share classes and what I just showed you, the C share classes. A B share class does not charge an upfront fee, so all of your money is put to work right away, but it charges a fee when you sell it. The fee is usually 6% if you sell it in year 1, and that fee is reduced 1% each year. After year 6, once you are free and clear, it automatically converts to an A share since those internal fees are lower. Then you have a C share class. You do not have an upfront fee or a fee to sell on the back end. Instead, you are charged 1% each year you own the fund. This share class offers the most flexibility, especially if you jump in and out of funds regularly, but the internal fees are significantly higher than any other share class. The last share class is known as institutional shares. This is for high net worth investors, and these share classes offer the lowest fees. The typical minimum investment per fund is anywhere from $200,000 for one fund all the way up to over $1 million for one fund. That's if you're going to buy it outside of a company retirement plan. But fortunately for us, if we're participating in our company's 401k or 403b plan, we have access to these institutional shares. You also have no loads. As the name says, there's no commissions, there's no loads, but the internal fees still pertains to you. You know those fancy Fidelity commercials that you see on TV? Guess what? They cost money, and we have to pay for that. And then finally, you have the advisor AUM fee, and that just stands for Asset Under Management Fee. If you are using the services of a financial advisor, they may charge you a commission or an asset under management fee. If you pay them commissions, then the A, B, and C share class commissions apply to you. If they are charging you an annual asset under management fee, then the commissions are void, but you're still being charged the internal fees as well as the advisor fees. And that could be 1%, 1.5%, all the way up to 2%. Where did all my money go? Grandma, they went to fees. That's where all your money went. Here's some more information on mutual funds. You have a fund prospectus. This is the document that will disclose the fees that you'll pay as well as the following information about the fund investment objectives, the rates of return, the portfolio holdings, and the portfolio manager information. And this one's also very interesting. One more thing to consider before investing in a mutual fund is to take a look at the portfolio manager. The manager is a person who makes the investment decisions with your money. We want to know if the current fund manager is responsible for the fund's past performance, or did they just take over the fund? If so, the past performance is meaningless. So let me tell you a story about a fund you may have heard of. It's the Fidelity Magellan Fund. All throughout the 80s, this fund was the king on Wall Street. This guy right here, Peter Lynch, he was a portfolio manager, and he was one of the most famous investors of all time, and for very good reason. He posted returns for his fund when he managed it from 1977 to 1990 of 29.2%. That's insane. However, all good things come to an end. And the end for this fund, not the fund itself, because the fund still exists, but the end of their stellar performance. That came when Mr. Lynch decided to go live the good life in retirement. What do you think happened to the performance of that fund after he retired? Take a look at this. A much lower return. It went from averaging 29% to just 6.6% for the last 15 years. Many investors in the 90s, they were still dumping money into this fund because they were intrigued by the past performance of the fund. The fund was still active. It operated under the same name. Why on earth would Fidelity change the name? And Fidelity is legally allowed to post the past performance numbers. But a new manager took over, and they had nothing to do with those amazing returns from the glory days of Peter Lynch. Investors were investing based on past performance of a manager no longer associated with the fund that they are investing their money in. Before you invest in a fund, you need to look at the track record and see how long the manager has been there. Are they the ones who are responsible for that track record, or are they a new manager to that fund? If they're new to that fund you're researching, what did their track record look like at their previous fund? And if they never managed a fund before, you may want to look somewhere else. Just like the different types of stock and bond categories that you can invest in, mutual funds have similar categories as well. With all the options available, investors should have no problem finding a mutual fund or mutual funds that have investment objectives to suit your needs. There are many types of stock funds. First, you have growth funds, and the objective is capital appreciation, and profits are reinvested into the company and usually does not pay a dividend. You also have what's called income funds, and some people call these value funds. The objective here is capital appreciation, and profits are usually paid out to investors in the form of a dividend. And you also have index funds. The objective here is to mimic the performance of a specific stock index, such as the S&P 500 or the Russell 2000. Index funds offer lower fees since the fund is not actively managed. Then you have small cap funds. The objective here is capital appreciation, and it seeks to invest in companies that have a market cap of anywhere from $300 million to $2 billion, and usually they do not pay a dividend. You can also invest in mid-cap funds with the objective of capital appreciation, and this seeks to invest in companies that have a market cap of $2 billion to $10 billion. You can also invest in large cap funds. The objective here is capital appreciation also, and it seeks to invest in companies that have a market capitalization of 10 billion and greater. And dividends are common amongst this category. Another way to accomplish the type of diversification that a mutual fund offers would be to buy shares of an exchange traded fund, also known as an ETF. Warren Buffett once said that if you don't have the time, desire, or knowledge to pick individual stocks, then the smartest thing you can do is to invest in an S&P 500 ETF for the long term. Exchange traded funds, I'm going to refer to these from now on as ETFs, are investment funds traded on a stock exchange. An ETF can create a diversified portfolio with just one purchase. Unlike mutual funds, where you have account minimums, usually between $500 to $1,000 for each fund, there are no account minimums to buy shares of an ETF. If you only want to buy one share, you can do that. Most of the ETFs have been created in order to replicate the performance of market indices such as the S&P 500, the Dow Jones Industrial Average, the Russell 2000 Index, or a sector-specific index. ETF trades on exchanges just like stocks do, so you can buy and sell throughout the day, unlike mutual funds, where you can only buy or sell at the close of the business day, which is 4 p.m. Eastern Standard Time. Here's some advantages of ETFs over mutual funds. You have the possibility of tracking the whole market with just a single purchase. ETFs are tax efficient. Unlike an actively managed mutual fund that sells securities for a gain, to meet shareholder redemptions, or when the fund manager changes, an ETF sells securities to reflect the index or sector. And most capital gains are delayed until you sell the fund. Your money's not pulled together with assets of other investors, so their actions won't affect you. Also, there's more transparency. The S&P 500 Index ETF invests in, take a guess, the S&P 500. What does the Fidelity Magellan Fund invest in? And what is a Magellan anyway? I don't know if that's an international fund, a bond fund, a small cap fund, or a large cap fund. So there is more transparency when it comes to investing in an ETF. Also, and this is why I like it, you can use strategies such as stop losses and covered calls, and you can't do either with mutual funds. And here's another reason why I like ETFs over mutual funds. The management fee on an ETF is significantly lower than the fees associated with mutual funds. Usually 0.5% or lower is all you're paying to own an ETF. And they usually outperform mutual fund managers, but it's not guaranteed. Here's a Vanguard ETF, and this is one that Warren Buffett refers to from time to time. And this is not a recommendation. This is just an example of what the fee comparisons are from a common ETF like this one to a comparable investment vehicle such as a mutual fund. And what we see right here is that the net expense ratio on the previous fund we were looking at, the mutual fund, was 2.11% plus commissions to buy or sell. Here you're looking at a total fee of 0.04%. And that's a lot cheaper than the category average. But even if you invest in any of these other ETFs within this category and not Vanguard, you're still only paying around 0.33%. That is so much cheaper right there. And you're looking at a 5-star fund versus a 1-star fund. How much can the lower fees save you in the long run? Here's a side-by-side comparison of the Vanguard ETF and the Thornburg Value Mutual Fund using the following data. We're investing $100,000. We're only earning a 6% rate of return, and that's going to be static for the next 25 years. So take a look at these numbers. They are staggering. Although the total fees for the Thornburg Mutual Fund exceeds 3%, once again, I'm only using the net expense ratio in this calculation, which is 2.11%. And we're compare that to the Vanguard Fund, that is 0.04%. The total fees over a 25-year time period for the mutual fund is over $179,000, and the total fee for the ETF, the Vanguard Fund, is $4,200. That's it. The total portfolio reduction of future value is 41% for the mutual fund and just 1% for the ETF. And most importantly, the account value in 25 years is just under $250,000 for the mutual fund compared to $425,000 using the ETF. Both accounts start at the same value. Both earn 6%, and they're both invested for the same 25-year time period. The factor that made the final figures so drastically different is the impact of portfolio fees. And this is just on a $100,000 account. The difference will be much larger for accounts with higher account values. By investing in the lower cost fund, your portfolio would be almost $175,000 larger just due to the lower cost of ownership. Why is there such a big difference in fees? Mutual funds are actively managed. Buys and sells occur every day, and those buy and sell transactions create transaction fees. Since they're actively managed, the fund manager gets paid a lot of money to manage the fund, hence the management fee. ETFs are not actively managed. Therefore, the transaction costs are extremely lower. The fees here are a commission from your broker that you use or an asset under management fee, along with a very small internal fee as you saw in the Vanguard fund. Since ETFs are not actively managed, there's no need to pay a highly compensated portfolio manager. If you're investing in an S&P 500 ETF, the only time a transaction will occur in that fund is when a company within the main S&P 500 index is changed. Then a change has to occur in the ETF to reflect that change. This may only happen a couple times each year. Every index is different. The Russell 2000 has many more companies within that index, and the companies within that index are changing more frequently. But the Dow Jones Industrial Average, that's only made up of 30 companies, and this index changes much less frequently. From 2011 to 2018, the Dow Jones only had a change in the 30 companies that make up that index just 6 times. That's less than 1 time a year. So why pay the unnecessary fees of a fund manager when there are no transactions that need to take place? Here's a very interesting fact about mutual funds and their portfolio managers. According to MarketWatch.com, over the last 15 years, 92.2% of large cap funds lagged the simple S&P 500 index fund. The percentage of mid cap and small cap funds that lagged their benchmarks were even higher. 95 and 93% of those funds failed to perform as well as their benchmark. CNBC has a similar stat. 95.66% of domestic fund managers failed to perform as well as their benchmark. And 93.95% of managers investing in international funds lagged their benchmark. This means they're underperforming the market. You're paying high fees for underperformance. ETFs mimic the market indices, also known as the benchmark. Mutual funds, they fail to perform as well as the benchmark over 90% of the time. So here's a genius idea for you. Invest in the benchmark. Savvy investors have taken notice of the many advantages offered by ETFs. And since 2005, the amount of assets invested in ETFs globally has increased from 396 billion to 4.4 trillion. And over the last 10 years, new assets growth rates, new money going in, are 16.5% for ETFs and just a 2% growth rate for mutual funds, and this is according to Morningstar. And as you can see here, there are massive amounts of money coming out of actively managed funds, that's the red bars, a small amount going into passive mutual funds, that's the light blue bars, and the money going into ETFs are staggering. So finally, I just want to do a side-by-side comparison of ETFs and mutual funds. So what we see up here at the top, continuous daily trading. ETFs, they do have that because they trade like stocks, whereas a mutual fund, you can only buy and sell at the end of the business day. Traded on exchanges, you do have that for an ETF, and you do not have that with a mutual fund. They both give you prospectus, they both provide diversification, you have a little bit more transparency with an ETF versus a mutual fund. Early redemption fees do not apply to ETFs. You can hold on to them forever, or you can buy them today and then sell them a minute later. You do have possible early redemption fees here, and it says possible because if you buy an A-share fund, there's no early redemption fee. If you invest in a C-share fund, there's no redemption fee. The only time you will have an early redemption fee with a mutual fund is if you buy a B-share. Next, sells holdings to meet shareholder redemptions. That does not apply to ETFs, but you do have that with mutual funds. Then are they actively managed? Some ETFs are, very few, but most mutual funds are actively managed. And then does it track an index? Yes, ETFs, they're designed to track indexes or indices, and some mutual funds do. So that gives you a side-by-side look of comparing the mutual funds to the ETFs. So those are 2 ways investors can invest in the stock market, have diversification, and not have to worry about the research or just trying to pick individual stocks. Here's your learning activity for this section. I can't tell you what option is right for you in terms of investing in mutual funds or exchange traded funds. My goal here is to educate you on the differences. You need to decide for yourself which option fits your needs the most, or have a financial advisor do that for you if you wish to do so. Since I'm here to educate you, you need to go back and look and see what fees you're paying on mutual funds that you currently own. If they are acceptable to you, great. If they're higher than you expect, then you need to make some changes. Once you see what the fee is, compare that to any exchange traded fund that's in the same category as your mutual funds. For example, if you own a small cap growth mutual fund and you're unhappy with the fees, then compare that to a small cap growth ETF. If you don't know where to start looking, you can use the ETF screener on Yahoo. Look at some of the larger ETF providers such as iShares, PowerShares, and Vanguard, or just simply do a Google search. So I hope you found this section helpful. If you have any questions, please feel free to reach out to me directly, tom@wallstreetvalue.com. And that's it for today, folks. I will see all of you guys over in section 8, an introduction to technical analysis. Take care, everyone. I'll see you soon.